We focus a lot on fundamental revisions and really drivers of upside. So in the case of Amazon, we remain bullish on Amazon because of the company's rapidly growing high-margin revenue streams, their advertising business, Amazon Web Services, and also Prime subscription revenue, which is essentially enabling Amazon to continue to invest harder than they ever have while also delivering higher profitability. We also focus on Alphabet. We're still bullish on Alphabet, where we think that the punchline is through the combination of mobile search, YouTube, and desktop search, top line will remain strong, and we also think that it will lead to bottom line revisions as well.
I get that for those two stocks, but when it comes to Netflix, there is a concern that rising interest rates impacts its balance sheet. When I take a look at any credit metric, I mean, take total debt to equity, 182% for Netflix. Should investors be concerned about the debt on the balance sheet and the company's ability to access capital?
I don't primarily cover Netflix. It's covered by our media team, so I don't have any official comment on it, but I think I'd probably just defer to the media team for any official view on Netflix.
All right. It sounds like you're telling investors that you can't put in rising interest rates into your fundamental models. So are you saying ignore it, or do you acknowledge that the environment has an impact on the trade because the trade has rolled over and has been rolled over for the past couple months?
We acknowledge that it does impact the long-term discounted cash flow valuations around these companies, but fundamentally, the companies are not expensive on a lot of metrics right now. For perspective on Alphabet, Alphabet is currently trading at 9 times 2020 free cash flow for mid-20s free cash flow growth. So, yeah, rising interest rates may have some impact on valuation, the way investors think about the overall market. But I would argue that a lot of these mega cap tech names are still not that expensive relative to their overall fundamental growth drivers.
Do you worry about regulatory issues, most especially with Alphabet? And were they in any way materially affected, or will they be, by the disclosure yesterday that they hadn't disclosed some potential security weaknesses?
So what we've written about regulatory so far is we do expect the regulatory drumbeat to remain loud through the 2020 presidential election, the 2020 presidential season. We expect that to continue. As a result, we do think it's going to hold back the investors' willingness to put multiples and really what the multiples they will pay for these names. We don't think that's going to go away. It's part of the reason why we think Alphabet trades at the current multiple that it does. With that focus, this is why we really are paying attention to upward revisions, because regulatory is going to hold back the multiple, but as long as the actual estimates are bigger than expected, we do think the companies will be able to outperform their peers in other sectors.
And that's what happened with Facebook? I say that sort of sarcastically because it's not what happened with Facebook. That there is something holding back the multiple, and it probably is regulatory concerns.
Yeah, I would argue on Facebook it's a combination of regulatory concerns as well as uncertainty around forward earnings power and fundamentals. I think there are real question marks around Facebook's ability to monetize the stories engagement, which is the fastest growing source of engagement on the platform. So that puts increased investor uncertainty around revenue growth. I would argue there's increased uncertainty around forward operating expenditure and how much Facebook's going to invest. So yes, regulatory is playing a role in Facebook, but there are other sort of idiosyncratic factors around revenue and forward operating expenditure that are also holding back the multiple temporarily until we get into 2019.